What if I told you that the biggest financial institutions on the planet are quietly buying up one of the most hated EV stocks of the decade, right at the exact moment when regular investors are giving up on it completely? Today is August 10th, 2026, and we are witnessing one of the most dramatic divergences in the entire market. Retail sentiment has hit absolute rock bottom. But behind closed doors, Wall Street is executing a massive accumulation phase in NIO stock. And here's the part almost nobody is talking about. Something fundamental just shifted inside NIO's business. Vehicle margins exploded to 18.8%, and that single number changed everything about the investment thesis. But before you buy or sell a single share, you need to understand that this is not just another speculative retail rally. In this video, we are going to break down the cold, hard data, the institutional buying sprees, upgraded price targets, a massive hidden asset worth over $100 million, and the exact option chain levels that reveal where the smart money is quietly setting its traps. If you're the kind of investor who wants to be ahead of the crowd instead of chasing it, do me a quick favor and hit that subscribe button right now, because you are not going to want to miss where this ends up. To understand why the big players are stepping in at this exact moment, we first have to look at the sheer scale of the retail capitulation. If you bought into the 2020 EV hype, you already know the pain. NIO is currently sitting on an agonizing 89% drawdown from its 5-year highs. On forums like Reddit and StockTwits, retail investors are officially throwing in the towel. They've been exhausted by years of underperformance, dilution, and broken promises. Honestly, can you blame them? After watching a stock bleed out for that long, most people would rather never hear the name again. But look at the other side of this story. While retail capitulates, NIO's session momentum is quietly picking up, closing its latest session at $4.74, up 2.8% on solid volume. Wall Street isn't buying because of blind hope. They're buying because NIO's operational fundamentals are undergoing a massive pivot right under everyone's noses. But how on earth can a stock down 89% suddenly justify this level of institutional interest? What could these firms possibly see that the rest of the market is missing? The answer lies in a single record-breaking operational milestone that dropped just days ago. On August 1st, NIO dropped a bombshell delivery report for July 2026, delivering a record-breaking 35,934 vehicles. That is a staggering 71% jump year over year. Year-to-date, NIO has now shipped 227,057 vehicles, keeping them firmly on track to hit CEO William Li's ambitious annual growth target of 40 to 50%. In fact, NIO is now leading its main domestic rival, Li Auto, by over 3,117 units in cumulative 2026 volume. But wait, because there's a twist hiding in this report. While the year-over-year growth is absolutely massive, deliveries actually dipped 11.5% compared to June's near-record high of 40,597. This is the first sequential decline in 3 months, and it explains why the stock has faced some near-term pressure. So the real question becomes, why isn't Wall Street even slightly worried about that dip? What do they know that would make them shrug off a decline like this? To answer that, we have to look under the hood at NIO's brand new multi-brand strategy. NIO is no longer just a luxury brand. They have quietly built a three-headed monster. In July, their premium core NIO brand accounted for 20,008 units. This matters enormously, because these vehicles sell at a premium average transaction price of 434,600 yuan, which is roughly 64,000 US dollars per car. At the same time, their new family-focused brand, NIO, delivered 10,155 units, and their compact high-end brand, Firefly, delivered 5,771 units. By segmenting their offerings this way, NIO is now capturing everything from the ultra-luxury buyer all the way down to the mass market. But here's the thing that should be running through your mind right now. How is this rapid expansion affecting their bottom line? Because normally, scaling 3 brands at the same time burns an absolutely enormous hole in an EV maker's pocket. So is NIO quietly bleeding cash to make this happen, or is something completely unexpected going on? If we dig deeper into the actual balance sheet and margins, the reality is going to surprise you. This is where the entire bear thesis starts to completely fall apart. Many retail investors still think NIO is a hyper-risky, cash-burning machine on the verge of bankruptcy. But the data tells a radically different story. NIO's profitability is scaling fast. Their vehicle margin has surged to an impressive 18.8%, up from a measly 10.2% just last year. Let that sink in for a second. That means NIO is now squeezing nearly twice as much profit out of every single car they build. This is the number that changed everything, and it's the reason the smart money suddenly woke up. And if you're still worried about their runway, take a look at their survival buffer. NIO is sitting on an immense liquidity pile of $6.64 billion to $7.0 billion in cash and short-term deposits. This massive safety net gives them years of runway to fund all three brands without needing to dilute shareholders. So the bankruptcy narrative, it's essentially dead. But if the fundamentals are this strong, why isn't everyone already piling in? With margins expanding and a fortress balance sheet, it was only a matter of time before the smartest minds on Wall Street took notice. While retail investors are complaining online and dumping their shares in frustration, the smart money is quietly taking control of the company. Institutional ownership of NIO's outstanding float has climbed to an astonishing 48.55%. Read that again slowly. Nearly half of NIO's entire stock is now locked up by major investment firms, hedge funds, and asset managers. While retail sentiment turns bearish and fearful, institutional investors are staring at the cheap valuation, the expanding margins, and the strengthening balance sheet, and they are aggressively accumulating. They know that when the retail crowd finally realizes this turnaround is real, those same people will have to buy back in at much higher prices. So which specific institutions are actually leading this charge? Because if you think this is just some passive index fund quietly rebalancing, you are in for a real shock. Let's look at the actual regulatory filings, because the numbers here are almost hard to believe. UBS Asset Management increased its stake by an absolutely mind-blowing 3,966.7%, adding 5.19 million shares to its portfolio. Bank of America literally doubled its position, purchasing 7.08 million shares to bring its total holding to 14.23 million shares. And it doesn't stop there. Renaissance Technologies, one of the most successful quantitative hedge funds in all of history, boosted its stake by 70.2%, now holding 14.45 million shares worth over $87.1 million. Meanwhile, Ascenigan Asset Management didn't just add to a position, they initiated a brand new stake valued at $19 million. So when quantitative geniuses and global banking giants are all loading up at the very same time, you have to stop and ask yourself one simple question. What do they see that the average retail trader is completely missing? Naturally, this aggressive institutional buying has forced Wall Street analysts to seriously reevaluate their targets. The upgrades are coming in hot and heavy. Goldman Sachs recently upgraded NIO to a buy, with a $7 price target. Goldman specifically highlighted the successful launch of NIO's high-margin premium SUVs, the ES8 and ES9, and the massive positive impact they're having on the company's average transaction price and margin expansion. In other words, the exact 18.8% margin story we just talked about. Today, at the same time, Zacks Research has upgraded the stock to a strong buy. Zacks is now forecasting that NIO will achieve sustained GAAP profitability by 2027, expecting fourth quarter 2027 earnings per share to swing positive to 4 cents. This is a monumental milestone because the lack of GAAP profitability has been the single biggest anchor weighing down this stock for years. But as impressive as these analyst targets sound, there is one hidden asset that NIO owns that almost nobody on Wall Street is even talking about. And when you hear this one, it might just blow your mind. This is a hidden catalyst that could quietly supercharge NIO's entire balance sheet. NIO was the only electric vehicle manufacturer on Earth permitted to participate in the strategic IPO placement of China's largest memory chip maker, CXMT. NIO made a modest strategic investment of $23 million back when CXMT was priced at just 8.66 yuan. Now fast forward to the IPO itself. The stock soared by an unbelievable 500%, closing its very first session at 49 yuan. That means NIO's small little chip bet is now worth a massive $132 million. Do the math, and that translates into a cool $100 million plus paper gain. Now, while this gain is locked up for 18 months, it does two enormous things. It dramatically strengthens NIO's balance sheet, and even more importantly, it secures their long-term supply of high-end automotive memory chips in a world that is desperate for exactly that. Could this quietly be one of the smartest side bets any automaker has made this decade? Now, a long-term turnaround story is great, but what does the immediate path actually look like for the coming days? To figure out where NIO is headed next week, we have to look at the real battlefield, the place where market makers and traders fight it out. The options chain expiring August 14, 2026. If we look at the call side, there is a massive resistance ceiling with heavy open interest concentrated at the $5 strike, sitting at 5,886 contracts, and the $5.50 strike at 6,536 contracts. Market makers are going to fight hard to defend these levels. But on the put side, we have a very strong support floor at the $4.50 strike, holding 3,867 contracts of open interest. What this tells us is that NIO is highly likely to stay pinned between $4.50 and $5 in the very near term, which makes that $4.50 level an incredibly attractive entry zone for buyers. But this options data only tells half the story, because there is another massive force quietly working in favor of the NIO bulls right now. For years, NIO was an absolute favorite target for aggressive short sellers, but that bearish grip has completely broken. NIO's short interest has plummeted to a 32-month low of just 5.22% of the float, representing 128.28 million shares. Even more important is the days to cover ratio, which currently sits at 5.2 days. Think about what that means. It would take short sellers over 5 full days of average trading volume to buy back and cover all their positions if a sudden rally kicks off. Because short sellers have been steadily covering and quietly exiting, the immediate risk of a violent downward collapse has been dramatically reduced. As that supply dries up, it provides a steady baseline bid underneath the stock. So could this be the calm before a major move higher? Now, none of this matters if we don't look honestly at the major risks and near-term hurdles standing in NIO's way. Mark your calendars for September 1st, 2026. This is NIO's second quarter earnings release, and it represents the single biggest near-term hurdle for the stock. Wall Street is currently anticipating a heavily narrowed loss of just 7 cents per share. Now, while that is a massive improvement, we have to stay grounded in reality. China's intense EV price wars are still raging, and NIO will remain technically unprofitable on a GAAP basis until 2027. So more cautious investors might want to wait for this earnings report to clear before committing a heavy allocation, just to make absolutely sure there are no surprise margin hits from all the recent discounting. So knowing both the massive catalysts and this near-term earnings risk, how should we actually approach trading this stock? If you're looking to trade NIO for quick short-term gains, here is the exact tactical setup. Your primary entry parameter, Zone 1, is between $4.55 and $4.60, which lets you buy very close to that major $4.50 option support floor. Alternatively, if you prefer a momentum entry, Zone 2 triggers on a daily close above $4.82, which officially clears NIO's 20-day simple moving average. For risk management, you'll want to set a strict stop loss at $4.30 to protect yourself in case NIO breaks below its recent 52-week low. From there, your short-term targets are $5 at the options resistance wall, followed by $5.36, which lines up perfectly with the 200-day moving average. But what if you're not a swing trader at all? What if you want to hold NIO for the long-term macro trend? For long-term investors, the strategy shifts to steady, patient accumulation. Your entry zone here is a simple dollar-cost average, or DCA, between $4.40 and $4.80. Frankly, anything under $5 is an incredibly attractive long-term accumulation zone given NIO's underlying valuation. For risk management on the long side, your stop loss sits at $4, which would represent a structural break of major analyst floors. But if NIO's multi-brand strategy succeeds the way the data suggests it might, your upside targets are enormous. The conservative Wall Street consensus target is $6.70, representing a moderate buy. Goldman Sachs targets $7. And TradingView's consensus target goes all the way up to $7.22, which implies a realistic 41 to 52% upside potential from current levels. So let's tie absolutely everything together and deliver the final verdict. When you weigh all of the evidence side by side, NIO stock lands as a clear moderate buy. The operational turnaround is now officially confirmed, with vehicle margins expanding to 18.8% on the back of those premium ES8 and ES9 sales. The smart money is heavily backing this move, with institutions now owning nearly half the entire float. And finally, the risk-to-reward ratio is incredibly attractive, supported by that heavy options floor at $4.50 and a massive 41 to 52% upside potential to reach Wall Street's target of $6.70 or higher. The era of retail panic appears to be ending, and the era of institutional accumulation has officially begun. Now, before we wrap up, a quick but important financial disclaimer. Everything shared in this video is for educational and informational purposes only, and it is absolutely not financial advice. I am not a licensed financial advisor, and I am not a lawyer. Every number and price target discussed here comes with real risk. Markets can turn on a dime, and past performance never guarantees future results. So please, always do your own thorough research and consider speaking with a qualified financial professional before making any investment decision. With all of that said, I want to hear from you. If NIO really does hit those institutional targets, do you think we'll look back on these prices under $5 as the single most obvious buying opportunity of the decade, or is the market pricing in a risk that the rest of us just aren't seeing yet? Drop your honest answer in the comments below. I read every single one. If this data-driven breakdown brought you real value, smash that like button and subscribe so you never miss the next deep dive. I'll see you in the next video.